On Wall Street, wealth can evaporate as quickly as it materializes. Investors are riding the high of the most hyped market debut in history, and the next, billions of dollars are violently wiped from the board. In June 2026, SpaceX debuted on the public markets. Shares priced at $135 and rapidly soared, pushing the company's peak valuation to a staggering $2.6 trillion and briefly elevating Elon Musk to the status of a trillionaire. That rally has since collapsed. Shares are currently trading below their initial offering price, and while retail investors are nursing their losses, institutional short sellers have built up a massive $15.5 billion in paper profits by betting against the aerospace giant. Mainstream analysis attributes this decline to rocket failures and the heavy capital requirements of artificial intelligence. Professional traders, however, are focused on a structural liquidity trap. Deciphering this specific collapse requires an investigation of market mechanics rather than aerospace engineering. As a quick reminder, we are exploring these mechanics for educational purposes, and this is not financial advice. When SpaceX priced its IPO, it carried an enterprise valuation of $1.77 trillion. That translates to a multiple of 94 times the company's projected revenue, a premium that requires absolute financial perfection. This chart breaks down the company's $28.5 trillion total addressable market claim from their prospectus. The small slice represents traditional space revenue. The massive $25.6 trillion block, roughly 90% of the total, is allocated entirely to artificial intelligence through the xAI subsidiary. To secure that enterprise AI revenue without draining the cash it just raised, SpaceX executed a $60 billion all-stock acquisition of the AI coding company Cursor. By marketing itself as a high-margin AI software business rather than a heavy industrial manufacturer, SpaceX justified a sky-high valuation. That framing, however, left the stock with zero margin for operational error. That margin for error vanished on July 16th at the Starbase facility in Texas during the 13th test flight of the Starship rocket. During the startup sequence, telemetry data revealed that 4 of the Super Heavy booster's 33 Raptor engines failed to ignite. This triggered an automatic launch abort on the pad. The market reaction was swift. That single aborted flight wiped roughly $100 billion from the company's market capitalization in 2 days, as investors reacted to the projected $30.8 billion in capital expenditures for 2026. Software companies don't lose billions of dollars when a line of code fails to compile. The intense physics and immense costs of rocket development provided a severe reality check on the speculative AI valuation. While engine failures triggered the initial drop, the force driving the stock down now is a mechanical trap designed long before the IPO, a staggered insider lockup expiration. When the company went public, it restricted supply by offering an initial public float of just 4.24%. This artificial scarcity helped drive the massive price surge during the first week of trading. This comparison illustrates the impending supply shock. The small bar is the initial 4.24% float. The massive block represents the up to 911.5 million insider shares, slated to hit the open market on August 6th. Because of a pre-IPO stock split, early venture capital investors hold shares at an adjusted cost basis of just $84. This gives them a massive profit margin and a strong incentive to sell, even with the stock trading well below the $135 IPO price. As those shares unlock, passive index funds tracking the NASDAQ 100 and the Russell are structurally forced to buy this newly available float, regardless of the stock's current performance. Short sellers are explicitly front-running this mechanical supply shock. They are leveraging the fact that passive index funds must serve as guaranteed exit liquidity for pre-IPO insiders looking to cash out. Elon Musk has defended the company's long-term value, pointing to Starlink's growing orbital monopoly and xAI's expanding computing infrastructure as proof the business is fundamentally sound. He even took to X to warn short sellers directly, stating that the probability of survival for firms maintaining a significant bearish position against SpaceX over time is very low. But in the short term, the stock market is a machine governed by supply and demand. Through December 2026, the market must absorb massive multi-billion share unlocking tranches. Measured, concluding, understanding the mechanics of float dilution is just as vital as understanding rocket engineering. Building a visionary aerospace company is an incredible feat of physics, but it does not automatically guarantee a stable stock.